A home equity line of credit, or HELOC, is a second mortgage that grants you access to cash based on the value of your home. You can draw from a home equity line of credit and repay all or some of it monthly, similar to a credit card. With a HELOC, you borrow against your equity, which is the home's value minus the amount you owe on the primary mortgage. You still qualify for a HELOC if you have no mortgage and your home is paid in full. In this case, the HELOC is the main mortgage instead of a second one. An advantage to HELOC is that it gives you the flexibility to borrow against your home equity, and once you have repaid, you can repeat the process if you wish. The interest rates on most HELOCs are adjustable, which means that the interest rates on your HELOC will go up or down along with baseline interest rates. The lender will start with an index rate and then use your credit score to determine interest rates on your loan. You should request to see what the interest rates will amount to before following through and signing anything. There are some general requirements that could vary depending on the lender when applying for a HELOC. You will need a debt-to-income ratio of 40% or less, a credit score of 620 or higher, and the value of your home needs to be at least 15% more than you owe. When you apply, you will need to provide certain documents to submit to the lender. They may vary but generally include copy of most recent pay stub reflecting 30 days and YTD earnings, most recent 2 years of W-2 forms from your employer, or if self-employed. Most recent 2 years personal IRS tax return documents including all schedules. Most recent 2 years K-1s from the partnership, LLC or S corporation as applicable. Or if Social Security benefits. Copy of most recent retirement award letter or most recent 1099 SSA, miscellaneous income form. Most recent bank and investment statements. Most recent IRS tax return as applicable. If you receive a pension or retirement benefits, copy of most recent bank statements. Written verification from the organization paying income, copy of most recent award letter, most recent 1099 tax form, or most recent 2 years personal IRS tax return documents. If you are commissioned, copy of most recent pay stubs reflecting 30 days and YTD earnings, most recent 2 years 1099s or W-2ES, most recent 2 years personal tax returns with all schedules, proof of homeowners, hazard, and flood insurance. Hazard insurance is required for all mortgage loans and home equity lines of credit. Proof of insurance includes a policy or certificate of coverage, declarations page, a copy of the master policy from your homeowners association, if applicable, insurance binder, property insurance form, or payment receipt. If you live in a special flood hazard area, you'll need to send us your policy's declarations page or a copy of the master policy from your homeowners association, if applicable, that shows you have adequate flood insurance coverage for your home you're requesting to use as collateral. You may also need to have your home appraised in order to present its current value to the lender. Once you have gathered all necessary documents along with personal information and found a trusted lender that will suit your needs, it is time to apply for a HELOC. Once you apply, you will receive government-mandated disclosure documents. One is a loan estimate that details the terms of your loan, including a clear list of all current and future expenses such as balloon payments, the calculated mortgage payment including taxes, insurance and other assessments, the estimated closing costs, and the cash amount you'll need to present at the time of settlement, information on services that are permitted or prohibited to hire. Examples of these services could be pest inspections or home appraisals. 3 days before you close on your HELOC, you will receive a closing disclosure. This is similar to the loan estimate. The difference is, this is the finalized form in which all the costs are locked in. It will also list the exact amount needed to pay at closing. The 3-day period will allow you to review and compare the closing disclosure to the loan estimate to the closing disclosure for any changes. There are many more documents involved with a HELOC, but these 2 documents are required to be handed to you by law. It is important to review these documents to make sure the loan will fit your needs. There will also be an underwriting process. This process may not be as extensive as if you were applying for a mortgage, but it could still take a few weeks. Once you get past the underwriting process, all that is left is the loan closing when you place your signature on the final paperwork and then receive the line of credit. There are several factors that lenders take into consideration when determining the maximum amount one can borrow when using a HELOC. These factors can include value of your home, what percentage of that value the lender will allow you to borrow against, and how much you still owe on your mortgage. The HELOC has 2 periods known as the draw period and the repayment period. The draw period usually lasts for 10 years, and allows you to borrow from the line of credit. Monthly minimum payments often are interest-only during the draw period, but you can pay principal if you wish. When the HELOC is in the repayment period, you are no longer allowed to borrow against the credit line. Now you will pay back the loan in monthly installments that include principal and interest. With the addition of principal, the monthly payments jump up to a large amount compared with the draw period. The repayment period usually lasts for 20 years but can vary depending on the lender. As the loan comes to an end, you could end up owing a large lump sum or balloon payment that covers any unpaid principal. It would be a good idea to negotiate a refinance or loan extension option as part of your loan to fall back on, should you find yourself unable to pay a large lump sum or balloon payment. There are some disadvantages to a HELOC. The main one is you risk foreclosure on your home if you are unable to make payments. HELOCs also have adjustable interest rates that could cause your payments to increase. There are a number of upfront costs when getting a HELOC, including application fees, title search, getting your home appraised, real estate attorney fees, and so on.